Hey everybody, Serge Berger here. In this video, I would like to share with you what I have found to be by far the most effective moving average for the S&P 500, for some stocks, and also for the NASDAQ 100, which also means it's an important moving average for lots of people's portfolios, be that an individual investor or an institutional investor. I will say though, moving averages are important to use, but they are certainly no way a holistic analysis. I would always encourage people to do much more than using moving averages, using structural, fundamental analysis as well, where applicable. But let's go talk about it. I will bring up here the chart of the S&P 500 now. What's important to note is that this is a monthly chart, meaning each one of these bars here is 1 month. So the moving average we're talking about here is not on a daily chart. It's not on a weekly chart. It's on a monthly chart. And the moving average specifically I'm referring to here is the 17-month moving average. That's right. Not 17-day, not 17-week, 17-month. The moving average here on the chart is blended in as a blue line. And I think if you look at this, you can see pretty quickly that it is pretty darn effective. We can go in a bit closer. Starting off in the 1990s, you can see as we keep above the moving average, the S&P goes up. When it breaks below it, the S&P tends to go down. At the very least, what tends to happen when the index breaks below the moving average is things tend to get choppy, which is also a great time to get out. So it's extremely effective and something that I would encourage everyone to use. Even in COVID, which was completely unprecedented what happened there, we broke below it, the moving average, which is a good time to get out just for risk management purposes. But then as we got back above it, shortly thereafter, it was time to get back in, and that was a hell of a trade. Now, what's also really interesting is that the 17-month moving average was also what once again served as the bottom in October of 2023 before this recent sharp rally. So as you can see, the 17-month moving average has a lot of relevance. One last point on the 17-month moving average before making a couple more important points as they're here right now. Typically when the S&P 500 is trading about 10% plus above that moving average, it tends to get overbought. Currently, we're about 14-15% above it. So I would say caution is warranted. Now, let's talk about sector and group rotation, because that is the topic of this week's research call. And if you look at this chart, you can see that the energy sector, it's up 18% year to date. It's absolutely taking the ball running away. Tech is up 7.5%. And so I think in many ways, the year has only just begun here as we have entered the second quarter, and we're going to see a tremendous amount of sector and group rotation opportunities that really at the end of the day is the name of the game for most, certainly institutional investors, professional investors, but also for most people at home. In our research call this week, we're going to go through all the details. I'll show you exactly how we do this. We can use ETFs. One can use stocks as well, and of course leverage with options or futures. The great thing about ETFs right nowadays is that there is one for almost everything. So if you're interested in sector and group rotation and even asset class rotation, this week's class is going to be, I think, very eye-opening. I look forward to seeing you guys there. As always, bring a pen and a piece of paper and register early.